closing options trades, why you should not close a naked position at 50%. Realistically speaking, what TastyTrade tells you, and I'm not even going to mention like Option Alpha because I think that they're a complete scam and they don't make any money, but I do have a tremendous amount of respect for TastyTrade, and to me it doesn't make sense, and it doesn't make sense mathematically why they recommend that you should close out both naked and verticals, and verticals are spreads, at 50%. So this is going to be a little bit of a difficult video for me because I actually have to think and do math in my head while I'm simultaneously speaking to you at a relatively rapid rate. So the fact is that, let me just go through some of the theory first. When you use a spread, you are mainly profiting. So for example, Facebook right now is trading at around 130, 132. Let's say you would sell a naked put option with a strike price of 120. All right. If you were going to turn that into a spread, you would also sell the 120 put, and then let's say you would buy the 110 put. So let's say in this example, you were going to sell the naked option on Facebook with a strike price of 120. All right. So you sell the 120. You will collect, just hypothetically speaking, let's say $3. Okay, this is a dollar sign. Then if you buy the 110, so you buy this, you sell this. This one is going to cost you $1. All right, so if you do the spread, you're going to collect $2. If you do it naked, you're going to collect $3. Now, what TastyTrade tells you is that you need to close both of these trades after you receive a 50% premium decay. So after this decays to $1.50, this is when you should close out the naked. And in this scenario, with the spread, when this trades at $1, then you should close it out and you would realize a 50% gain. The problem with this is that it doesn't make sense mathematically. And the reason is that even by TastyTrade's own math, all right, if you close out the spread at $1, what that means is that this option, the 120 that you sold, is probably going to decay down to around, I'd say like $1.20. Okay? And then this option that you bought at that time is probably going to be trading for 20 cents. Because remember, the rate of return of the higher priced option is going to be the one that leads your profits. Let me repeat that. The rate of decay of the option that you sell on the put side, the higher price option, is going to be the leading option that is going to determine your profits. So in this situation, when you're using the spread, when you close it out for $1, this option, which you previously closed out for $1.50, now you're waiting for this option to trade at $1.20. So when you close out that trade, what you're going to do is, let's say you sold the spread. So you would sell the $3 option, you would buy the $1 option. So you'd sell the 120, you'd buy the 110. That means on a net basis, you would collect $2 of net premium. Now, if you want to close that out, you would buy back the option that you sold, which is the 120, and you'd sell the 110 option. So in order to do that, you would buy back this 120. You pay $1.20 per share or $120 per contract. Then you would sell this. You'd sell it for 20 cents. So on a net basis, this decayed 80 cents. This decayed $1.80. Again, let me just make this clear. Decay 80 cents for the option that you bought, the 110 put on Facebook. For the 120 put on Facebook that you originally sold for $3, that decay is $1.80. As a result, here you would get a total net premium on the spread that you would keep would be $1. as you can see here, you would have 80 cents of decay. And remember, and here you would have $1.80 in decay. So the difference between this is $1, which is equal to the amount of premium that you keep. Now, here's the summary. If you're waiting for the leading indicator option to decay all the way down to $1.20, then you might as well wait for the naked option to decay to $1.20. Do you understand what I'm saying? It doesn't make any mathematical sense that you would close out the naked option and the spread at the same price. So I've done and run a few simulations. Obviously, I'm not running like 1,000 back tests like TastyTrade does, but I'm really shocked that they would recommend this. Why is it just doesn't make any sense why you can run this with any example that you want, why you would close out naked options and spreads at the same amount. Because in this situation, this same option that you're closing out, that you're proposing to close out at 50%, you will close this out at $1.50. But your risk is in the put that you're short. Here, with the spread, you're waiting for this to decay to $1.20. So you might as well wait for the naked option to decay to $1.20. Therefore, you would collect 10% additional premium. 10% additional premium. So 10% additional premium is the difference between $1.50 and $1.20. 10% additional premium from what they recommend would mean that you would close the naked option at 60% of the premium received, and you would close the vertical at 50%. So that's the conclusion that I get. And all of my analysis and the iterations that I've gone through propose that you should always close out naked options at 60 to 65% of the premium received, and you should close out verticals at 50%. And the entire reason, again, I'm going to make this very simple, is that when you trade a spread, your profits are dictated by the option that you sell. So in this situation, when we sold the 120 put and we collected $3, you're still, when you do a spread, selling the same 120 put and collecting $3. But with the spread, you're waiting for it to decay in value to $1.20, and here you're only waiting for it to decay in value to $1.50. So you might as well, because this put that you sell leads your profit, you might as well wait for this same option that you're selling to decay in price to $1.20. As a result, $1.20, you will sell it at $1.20, you will keep $1.80. All right? So here you will collect and keep 30 cents more premium. That's 10 cents, 10% more premium. So a rule of thumb is you should always close out naked options at 60 to 65% of the premium received. For verticals, you should close them out at 50%. I don't understand why TastyTrade tells you that you should close out naked options and spreads at the same amount, at 50%, because mathematically it just does not make any sense whatsoever. Seriously, it doesn't. Like, the put that you sell is the leading indicator of your profitability. So if you're going to wait for it to decay, this option to decay down to $1.20, you might as well just wait for this to decay to $1.10 to $1.20 and collect 10 or 15% more premium. So for example, if you wanted to put, let's say you were selling, I'm going to use another underlying. I'm going to use Lockheed Martin. Let's say you wanted to sell a 250 put in Lockheed Martin, and you were going to do it naked, and you were going to collect, let's say, $2. Okay? The second that this trade fills, you would then close out this trade for, I'd say, around 80 cents. Let's say 75 to 80 cents. All right? So you would sell the put with the strike price at 250, then immediately you would set a buy to close, good to cancel order with a strike price of 75 to 80 cents. As a result, this would allow you to keep around 60% to 62.5% of the premium. All right? So 70 to 80%, that way you'll do 60 to 65%. So this would be the amount that you buy it back. So again, just to reiterate, you're selling a put on Lockheed Martin with a strike price of 250. Once it closes, you immediately submit a buy to close order with a limit price, good to cancel, of anywhere from 70 to 80 cents, whatever you feel comfortable with. If you want to do 70 cents and you want to be more aggressive, fine. If you want to do 75 cents, that's fine. If you want to do 80 cents, that's fine. But this will automatically give you anywhere from 10 to 15% more premium over what TastyTrade recommends. Now, if you wanted to do a spread and you wanted to sell this same 250 put, but you wanted to buy the 230, and then you collected $2 here and then $1 here, that would mean that you would collect $1 of net premium for doing a 250 by 230 spread in Lockheed Martin, and you collected $1 in net premium. Then immediately once this trade fulfilled, you would submit a buy to close order that would have a limit good to cancel price of 50 cents. All right, so here you would collect, when you do the spread of Lockheed Martin, the 250 and 230, you would collect $1 of net premium for the spread, and then you would submit a good to cancel closing order for 50 cents, and therefore you would keep 50 cents. But if you're going to do it naked, and you would sell it at $2, immediately once it fills, you would submit a buy to close order with a limit price of either 70, 75 cents, or 80 cents. So again, I just want to make this clear that when you close out options trades, it does not make mathematical sense for you to close out naked options and spreads at the same price. Closing them out at 50 cents, at 50%, just does not make mathematical sense, because in options trade, and if it's a naked option versus a spread, they are not the same. You're still assuming a substantial amount of risk because you're on the spread, because you're waiting for the option that you sell to decay even more in value than it would if you had the naked option. So you might as well collect an incremental 10 or 15% of premium with the naked option and wait for it to trade down to the same exact level as it would for the spread in order for you to close out that spread at a 50% profit. So this is David Jaffe from BestStockStrategy.com. If you have any questions, let me know. You can go to BestStockStrategy.com and enter in your email address and receive over $400 worth of free options trading training information. It's the best information available. Nobody else has better products out there. And if you have any questions, you can leave a comment below. I'm here to help you, and I appreciate your attention.